we're looking at another S&P record in the making. 30 minutes until the start of trading. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a stimulus blitz. China unleashes a raft of support measures to revive the world's second largest economy.
Meanwhile, a flurry of corporate news here in the U.S. from a rare sell call on Starbucks to billionaire John Malone's latest power play.
Plus, Visa faces a Justice Department antitrust case on debit cards. Details on that Bloomberg scoop ahead. But first, let's take a look at where markets are trading with 30 minutes to go until those bells ring. You can see there's more green on the screen. We had been higher in the pre-market. Some of those gains coming back now, but still higher on the S&P 500, up 0.1%. Big tech in the lead, a narrow lead. Nasdaq 100 up about 0.2%. Of course, we closed at another record yesterday. We'll see if we can sustain that momentum. Of course, getting a boost from those China stimulus measures. And you're seeing that in the bond market as well. That rise in yields on the 10-year inching back to 380, Matt.
Yeah, I feel like the boost could be a little bit bigger. I was expecting more. Nonetheless, as Katie pointed out, we are at a record on the S&P. That's the index here in blue. You can see the tech index in yellow and in white. That's equal weighted. The point that this chart is trying to make is that you don't really need tech to drive us to a new record. Maybe we could see another one today.
Who needs it? Who needs it? Anyways, we're going to watch some stocks to watch here. We were talking about that Chinese stimulus measure, and you have Alibaba shares among Chinese stocks rising on that central bank stimulus package. More on that in a minute. Alibaba shares up about 5.9, almost 6%. Also keeping an eye here on Hawaiian Electric because it's a large mover today on the downside, down more than 12% now. So really extending that pace of losses throughout the morning, announcing 54 million new shares of common stock to be offered at $9.25 per share. We also want to look at Liberty Broadband after the cable company proposed an all-stock merger with Charter Communications, and Liberty shares now up 22% nearly, Matt. John Malone on a deal-making tear.
The Darth Vader of cable. All right, so it's really the China stimulus story front and center. When I woke up this morning and saw it, I instantly got excited, but then was a little disappointed. I mean, they're providing $113 billion in liquidity for stocks. They could do more.
Not quite a bazooka. It is a blitz, not a bazooka. It's interesting, though, when you think about the effect that we're seeing in the stock market, what this could mean for specific companies. We were speaking to the CEO of Pandora yesterday, who said that basically they've seen double-digit growth for 5 straight quarters everywhere except China, that China is still a difficult story. So it speaks to what we're seeing today.
Fascinating, because you have seen so much capital move to Japan and India, for example. So how much more foreign money will move into Chinese equities? But at the very least, to your point, that excitement is being exported across the globe. U.S. futures still higher. Of course, that trade that starts in Asia has been extended more and more so into the morning trade here in the United States.
Yeah.
And also, at the very end of the day, Matthew, everyone can be relieved that the central bank will always step in.
All right, well, whenever I wonder about emerging markets, there's only one person I think to talk to, and that is Damian Sassower. He's going to give us the details of this stimulus package because there were a lot of measures, right? Reducing borrowing costs, reducing reserves that banks have to hold, reducing regulations, encouraging second home purchases. Damian Sassower, Bloomberg Intelligence, standing by at the World Bank Global Business Forum. And Damian, what do we know about what's been announced?
Well, Matt, the first text that I got when I woke up this morning was from my 19-year-old son saying that we should be buying Chinese equities, so trump that one. But let me tell you about the stimulus package and what makes it unusual. In addition to them cutting the RRR rate, cutting mortgage rates, cutting the 7-day repo rate, what they also did was they announced the equity stabilization, sort of macro stabilization fund to support the equity market. What they also did is they created a swap facility that's going to allow insurers, other real money, fund managers, et cetera, to borrow against their equity holdings in the Treasury market. So, you know, a raft of measures, but what is unusual about it is it all happened at once. And what trumps that, I guess, from an unusual standpoint, Matt, is the forward guidance. PBOC Governor Peng Zhongkeng basically announced that they're going to be cutting rates again in the not-too-distant future, and there's more stimulus on the way in terms of perhaps making it easier for mergers and acquisitions and the like. So, you know, we're digesting it all, but I think myself and the market are a little bit mixed on exactly what impact it'll have on the real economy.
You know, there's a sense here, Damian, and it's interesting. You see, for example, the declines in the Nasdaq Golden Dragon Index only down really about, 8% this year after steeper declines in the last 3 years. Is it enough to really encourage more investment, to your point that you made on Chinese stocks here, when there's still that much uncertainty ahead?
Well, I think there's no question. There's a huge value premium in Chinese equities. They're lying flat, to coin that term. I mean, China itself is lying flat right now. So it's just a matter of, will it be extracted? And can the stock market really justify some of these multiples or higher multiples from here? I mean, Sonali, again, the reason here that most people, myself included, don't think the stimulus is going to have the desired impact is because of the amount of wealth and saving that's already been lost locally within China. In addition to that, the unemployment rate, which is rising and is high. So, people aren't going to spend money on those big ticket items, at least not locally within China. And I think finally, and this is from a foreign investor standpoint, the lack of regard to property rights for investors. And I think, if you just look at some of the performance we've seen year to date in China, I think you're seeing that a little bit now. Maybe perhaps if you look at China credit, dollar credit, I mean, let's be clear, Sonali, it's the best performing sub-asset class within emerging market debt year to date.
Well, Damian, let's talk about why they didn't go bigger, why they didn't unleash that bazooka that maybe some had been expecting. You think about what we saw from the Fed last week, surprising markets with that 50 basis point cut. Why doesn't the bank or the PBOC basically follow the Fed's lead here?
I think it's a great question. I think it has to do with the currency. It has to do with dollar yuan. Remember, the China yuan is a low yielder. It's a funding currency. Prior to the VAR shock we had when the carry trade blew up, people were funding in yuan to buy in dollars, to buy in Brazilian real and other high-yielding currencies like the Mexican peso. But, you're not seeing as much of that anymore. And I think the concern for officials in China is that if they continue to lower rates at this pace, it's going to continue to serve as a funding currency. And all the stimulus in the world and all the stabilization funds in the world are going to come right out of China's reserves in order to kind of prop up the currency. And that is indeed a risk.
Damian Sassower of Bloomberg Intelligence joining us from the Bloomberg Philanthropies Earthshot Prize and Global Business Forum in New York City. We're going to discuss this all now with Youngyu Ma, the Chief Investment Officer of BMO Wealth Management. And the point that Damian was making that particularly is fascinating to me is when we talked about the carry trade, this idea that people were funding their wagers across global equities, U.S. equities, big tech stocks, in yen. They were also doing it in yuan. How sensitive is a U.S. investor to the Chinese economy and therefore the movements in Chinese rates and central banking decisions?
Thanks. It's great to be here. That is a good question. I wouldn't say that the typical U.S. investor and the set of portfolio investments they have is particularly sensitive to what's happening in China. I think overall U.S. companies have a relatively low exposure at this point to China, and really the big driver is what's happening here at home. Although the global factors are important, it provides a kicker one way or the other. It can be a headwind or a tailwind. And we do see this as something that's important. It was a significant step, but it does remain to be seen in terms of China's stimulus, whether or not it can turn around consumer sentiment in the country and whether or not there are other changes that might be coming that would improve the investment environment in China as well. So there's still a lot of question marks out there, but it's a welcome step for sure.
I mean, they want to get to 5% growth, right? The party needs to see that. How likely is it that they actually achieve that target, or do they just massage the numbers to make it look like that happened?
Well, they're certainly trying to push in that direction. Whether or not they actually hit 5% might be a bit of a stretch. But I think ultimately it depends on whether or not we start to see a pickup in consumer spending. What do the people, the population on the ground see as the government steps being meaningful or not, and whether or not that changes their behavior? The savings rate is tremendously high. There's a lot of capacity to actually spend money if consumers choose to do so. It's just that the sentiment is still very negative for consumer purchases there. So whether or not this is enough to turn around sentiment, I think remains to be seen, and how much faith that consumers have in the government to really backstop the economy and backstop the markets. But it's possible, but it would take that consumer spending to really come in as a kicker. So we'll have to see how that develops.
Well, let's turn our focus stateside, of course, in the aftermath of that jumbo cut that we saw from the Federal Reserve last week. Of course, now that we're out of the blackout period, we're getting a lot of Fed speak. And we heard most recently from Austin Goolsbee saying that he sees many more rate cuts over the next year and that rates need to fall significantly to keep the U.S. economy steady. I'm curious what gap you see between the Fed and the markets right now when you think about that very aggressive pricing for more easing.
Well, the markets are pricing a lot more easing, and certainly comments like that, that's just one Fed voting member, so it's hard to extrapolate that across the spectrum. But the markets are pricing a lot of easing now, and I think a lot of the rally that's taking place and the positive sentiment that's building up in the equity markets is on the basis of more cuts this year, more cuts into 2025, and that trajectory just staying in place and really having the Fed at your back as a market tailwind. So we do think that will remain in place. Probably the market, in our estimation, is getting a little bit aggressive in terms of how many cuts it's pricing in. But at the end of the day, it's that trajectory that matters for the medium term. And we think that trajectory of lower rates remains in place here.
You know, it's interesting. Do you think most of the market understands how much rates really need to decline here in order to get that boost in the economy? There's the story out on Bloomberg Intelligence that's incredible. Buyers that want $35,000 cars, they want them at 3% loans, and that could be a massive problem moving forward because it would take a long time to get there. How much do rates really have to decline here to ease up the consumer that has been waiting to spend on houses, cars, and other big ticket items?
Yeah, that's a great question. We actually think the transmission mechanism of lower interest rates is going to be a lot quicker and more direct than in previous cutting cycles because these high interest rates, these high short-term rates have been with us for a while and really curtailed demand to some extent. We do think that there's going to be some front running of the lower rates. So we're already seeing some auto companies start to offer better financing terms. So we think to some degree that's going to start getting priced in already, either in anticipation of those lower rates or what's already happening along the yield curve. So we do expect this mechanism and the boost to the economy to actually take place a lot quicker than in prior rate cutting cycles. So we're quite optimistic here.
All right, well, that's a good place to leave it. Really appreciate your time this morning. That is Young-Yu Ma of BMO Wealth Management. Thank you. Meanwhile, let's get a check on futures. Of course, less than 20 minutes to go until the bells ring. You can see another green day, at least, that's brewing right now. The S&P 500 currently up about 0.2% pre-market. We closed at a record for the 40th straight time yesterday when it comes to the S&P 500. We'll see if we can build that momentum today. Meanwhile, you take a look at the Nasdaq 100, also up about 0.3%. Big tech still in charge. Now coming up, Mastercard releasing its latest holiday spending pulse forecast. We'll speak to Michelle Meyer. She is the chief economist at the Mastercard Economics Institute next to break it all down. This is Bloomberg.
Let's get now to high interest to look at what's making headlines around the world. Escalation of the tensions in the Middle East. Israel says it will speed up offensive operations against Hezbollah today. Its army chief says Hezbollah must not be allowed to a reprieve. Earlier today, Israel launched airstrikes on targets across southern Lebanon, killing nearly 500 people. It's the deadliest bombardment of Lebanon since 2006. The head of Novo Nordisk, the drug maker behind Ozempic and Wegovy, is set to face tough questions on Capitol Hill today about the high cost of the company's drugs. They are set to blame pharmacy benefit managers. Inconsistent insurance coverage for drugs has been forcing many patients to pay out of pocket. And Caroline Ellison is facing sentencing today. The former Alameda Research CEO is the star witness in the criminal case against FTX founder Sam Bankman-Fried. Ellison pleaded guilty on 7 fraud and money laundering counts, which could carry a statutory maximum sentence of around 110 years. But because she's working out a deal, she'll do, we can assume, I think, far less than that.
All right, let's turn our focus over to the consumer because the Mastercard Economics Institute expects retail sales to grow a little over 3% this year, powered by a boost in online sales. Let's get more details now from Michelle Meyer. She is chief economist over at the Mastercard Economics Institute, joining us on set. It's great to see you, Michelle.
Great to be here. Thanks for having me.
So 3.2% year-over-year growth. Of course, many would take that as good news given how many concerns there are focused on the consumer right now.
Yeah.
What do you see over at Mastercard as powering that growth?
Well, at the Economics Institute, we're looking at what we're seeing real time in the data, in our insights, and we see that the consumer has been out there spending, and they've been frankly spending throughout this whole recovery, even though people are underestimating the ability of this consumer to spend. And I think part of that is they are powered still by the health of the labor market. Income growth is running in excess of underlying inflation. Household balance sheets in aggregate are still pretty well supported. And I think consumers have been really mindful about how they're using that purchasing power, being selective, but on aggregate, overall, still spending, and we think we're going to run just above 3% for this season.
How sensitive is that to the labor market at this point in time? You see real-time trends, but we have future data. So how do you make the two pair together?
Yeah, so it's absolutely critical. Of course, what drives spending is the income that's created. And if you look at the labor market indicators, we've seen some moderation in the churn of the workforce, right? If you think at hiring rates from the JOLT survey or job opening rates as well. But if you look at the weekly initial jobless claims in terms of layoffs, they're still at record low levels. So overall job creation is still pretty robust. Again, wage growth is still running close to that 4% or so year-over-year rate, depending on which measure you use out there. And that is important in driving consumers and their ability to spend.
You know, we've known each other for a long time,
Yes.
Michelle. We've been through some economic cycles together, and I feel like people do always tend to underestimate the U.S. consumer. But can this consumer really power 18% earnings growth for the S&P next year? Because we've been talking about the fact that analysts are very, very bullish.
Yeah. Well, luckily, I don't have to make that call. But I do think in terms of the consumer, you know, even outside of what you're thinking in terms of overall earnings, it certainly has been the case that the consumer has been extremely active in this cycle. And I think that that speaks to how things started out in this recovery with a lot of stimulus, fiscal stimulus, monetary stimulus, coupled with a labor market that proved to be so much more powerful in driving spending, not only because of job creation, the churn in the workforce, but also because of more workforce participation. So we've seen some really strong supply side factors that have helped to drive this economic cycle. And I do think that matters for things like earnings. It matters for the bottom line for companies across the world.
For GDP growth. I mean, they still make up, what, 70%
Yeah.
of GDP growth?
Exactly. And look at where GDP is tracking in the third quarter as well. Real GDP is tracking close to 3% if you look at least the Atlanta Fed's most recent measure.
Yeah, so there you have it. I do want to return to this North Star of that 3.2% year-over-year retail spending forecast, because you think about sort of the value of promotions right now.
Yeah.
This is something we ask retailers all the time. What are you doing in terms of discounting? How are those sort of promotional offers working through your data?
So that is an excellent question, and I think really important when you think about breaking down that 3.2% year-over-year forecast for retail spend, retail sales ex autos. Relative to prior years, more of that spending is driven by real growth, right? Just more stuff being purchased because inflation has really moderated, particularly for a lot of the categories that fall into holiday sales. There's even deflationary pressure for some of those. Think about if you're going to buy a big ticket electronic item or an appliance, those are things that are deflating in price. So I think increasingly what you're seeing is more real spending volume, and that is a good balance.
How much do lower borrowing costs matter here? You saw that 50 basis point rate cut to the point that Katie was making a little earlier, and the read-through is what I think a lot of people don't understand. How quickly does that feed through into borrowing costs when you know the average credit card rate is closer to 25%? Are you seeing people provide ways to borrow more cheaply to buy these big ticket items? Will that be a place you could see a lift?
Yeah, I mean, borrowing costs obviously are down in part thanks to the Fed cutting by 50 basis points. That was a nice kickoff to the holiday season in some ways. But also remember that the market has moved well in advance of that initial 50 basis point cut. So when you look at how the 10-year Treasury, for example, has moved, it's down quite substantially, right? And almost 150 basis points from its recent peak. So that already, I think, has been moving into a lot of household borrowing costs. Think about the mortgage market. Think about average mortgage rates that have come down. That's supportive in terms of some refinancing or the potential to, purchase a home if you've been waiting in the sidelines. So it's not immediate. It's not as though you just snap your finger and all of a sudden it's a very different environment out there. But certainly with interest rates now coming down, it helps.
If you look at the savings rate, I'm looking at the savings rate over a long term, and obviously you have these giant peaks during the COVID or right before. Now we're back down to 2.9%, which is a fairly low level. Does that worry you looking into 2025?
So 2.9% is a bit lower than it had been historically, but remember how much above we were in the savings rate for such a long time. So to me, the movement in the savings rate is all part of this normalization that we're seeing in the economy. As the economy finds that equilibrium, which they have not been in, but we're getting closer to that. So when you think about, again, the breakdown of spending with more coming from real, that's, again, part of that balance. The savings rate falling below after falling above, that's part of that adjustment to equilibrium. So to me, it makes a lot of sense given where we were coming from.
Michelle, we thank you so much for your time. Of course, a great read on the consumer. Just before the holiday season, I've got to say, I'm already buying Christmas presents.
You're already shopping for Christmas?
Am. It's a bit insane, but we are there now. Thanks to Michelle Meyer of the Mastercard Economics Institute. To that point, there are great promotions out there. Now, coming up, we're going to talk about former President Trump because he says he'll hit ag giant John Deere with 200% tariffs if the company moves production to Mexico. We're going to talk about that in Social Climbers next. This is Bloomberg.
All right, time now for Social Climbers. The company's making waves this morning. And first up, former President Donald Trump threatening to hit Deere with steep tariffs if the farm machinery maker moves production to Mexico. He made the comments at a farmers event in Pennsylvania. Next up, we have Snap announcing it will start using Google's AI model Gemini to help power its own AI chatbot. Snap says that since it started using Gemini earlier this year, it's seen almost 3 times more engagement from users. And finally, Barclays analysts are bullish on Tesla, saying that they expect third quarter deliveries to top estimates. They note that the strength is coming nearly exclusively from China. In about 3 weeks, the EV company will unveil its long-awaited robo-taxi in California. Meanwhile, let's take a check on these markets. Of course, just minutes away from that opening bell, you can see green on the screen behind me, the S&P 500 up about 0.2%. Big tech a little bit more so, and then small caps a little bit more from there. Less than 4 minutes ago, we'll discuss the market moves with Maddi Dessner from Capital Group. That interview coming up next. This is Bloomberg.
We are moments away from the start of trading on this Tuesday. This is Bloomberg Open Interest. I'm Matt Miller. Futures are setting us up for yet another record close on the S&P 500. As Katie said, we've seen 40 record closes so far this year. Right now, we're up just 0.1% on futures, about 0.3% on Nasdaq 100 futures. Ringing the bell at the New York Stock Exchange, I believe, is Jennifer Granholm. Get back to the bell. Get back to the bell. Anyway, everyone's clapping. Yes, it is U.S. Department of Energy Secretary Granholm there. Down at the Nasdaq market site, CyberArk, the identity security company. But more importantly, will stocks rise to yet another record as we start to see trades get settled in? Let's get over to Katie Greifeld for the index moves at the moment. Katie?
40 record closes. Can we make it 41? At least if you look at the board right now, maybe we'll get there. If these numbers stay green, you can see the S&P 500 up about 0.2% right now, just seconds into the trading day. Not very big gains here, but again, in this market, you don't need big gains. gains. You have the Nasdaq 100, your big tech stocks up 0.4%, neck and neck with small caps, with the Russell 2000 up about 0.4% as well. Meanwhile, let's take a look at some individual stocks right now, and we'll start with Hawaiian Electric. Shareholders clearly not pleased with the company's plans to offer 54 million new shares of common stock at $9.25 per share. You can see that sending shares down about 13% right now, Sonali.
I'm also watching cable operators Liberty and Charter. Liberty is proposing an all-stock deal with Charter as we continue to see consolidation in the media space. Matt, we are talking about John Malone's empire here. Liberty is now soaring up more than 21%. Charter Communications down almost 1% after the announcement of this deal. Remember, Liberty also owns a significant share of Charter already, so this will be an interesting one to keep your eye on. And
Formula One, and more importantly, MotoGP. Very fascinating stuff from John Malone. Meanwhile, Alibaba and JD.com are among Chinese-linked stocks that are on the rise following the central bank's laundry list of monetary stimulus measures aimed at shoring up the economy. The Golden Dragon China Index just hit its highest level since July. I'm sure Carol Master is going to highlight this at the close.
Absolutely. She does love
She loves the Chinese
the
stocks.
ADRs,
Yeah.
all that interesting stuff, of course. We'll continue to follow that. But let's broaden out this conversation now with Maddi Dessner. She is Capital Group Head of Global Asset Classes, joining us on set. It's great to see you in person.
Thanks for having me.
So let's go back to last week. Of course, we had that jumbo rate cut from the Fed, and now you have a ton of people saying that those trillions of dollars that we see in money market funds going to start to come off the sidelines and go into the market. If you have money to put to work right now, where's the best place?
Well, first of all, we think it's always a good time to go back into the market. We think staying on the sidelines is really not a reasonable strategy because timing the markets doesn't make sense. You always miss the opportunities that you think you have. But when we think about what we are looking at in terms of opportunities, number one, there's a lot of focus right now on artificial intelligence. We think the application of artificial intelligence is really, really interesting. So think about the ecosystem of companies that benefit from artificial intelligence. It's not just about the technology companies. It's about drug discovery and healthcare companies that are incorporating this into their portfolios. It's about energy transition and making sure there's a tremendous amount of energy required to power AI. So that's a huge opportunity for us. Data centers, right? All of this artificial data that's being created needs a place to be housed. So data centers are a real opportunity for us. So artificial intelligence and the applications around that is something that we think investors aren't paying quite enough attention to right now. Well,
that's really interesting to hear you say. You say investors aren't paying enough attention to the applications of AI, but that's because we hear often on this show that it's too early to pick winners in that space. So what kind of due diligence do you have to be doing when you're trying to identify the winners on the application side?
Yeah, well, we are meeting with 20,000 companies per year. We're talking to company management. We're looking at their balance sheet, Katie. So we're doing a lot of discipline.
Can't AI do that for you?
Portions of it, but certainly there is no replacement. AI, the combination of the investor and the artificial intelligence, that's where we think the real magic is. But the other area that we've been focused on is international stocks, specifically areas that have strong growth prospects and strong balance sheets, areas that actually help you diversify away from the technology concentration that we're seeing in the U.S. So thinking about consumer stocks, luxury goods, pharmaceuticals, this is the kind of exposure that you're getting internationally. And when you buy those stocks, you're actually getting exposure not just to Europe, but to the entire world, because about 57% of the revenues coming into the MSCI Europe is coming from all over the world.
I saw recently also that the share of U.S. market cap relative to global market cap has reached another all-time high. A lot of people betting on America here. Yeah. But to the point that you were making...
You can't get luxury. To your point, Maddi, luxury stocks are all in Europe, right? I mean...
Matt's like talking Porsche now again. I know. It's
no, but also
Hermes,
LVMH, Kering. I mean, all that stuff is European, but you do get global exposure when you buy. It's not like you're buying a French company.
But exactly. China exposure as well.
You're getting exposure to the entire world. So not just Europe, not just China, not just emerging markets, but the U.S., right? If you think about the amount of global luxury goods that are being purchased by the U.S. consumer, I know your prior guest was talking about the U.S. consumer, which we think continues to be very strong here. And we're constructive on that consumer recovery, which I think will feed into a lot of these stocks that have that global exposure.
Maddi, how many companies again did you survey in order to find kind of these AI winners?
Well, I mean, we meet with 20,000 companies per year.
20,000. How many of those are winners, right? Because if you're scouring this massive universe, it cannot be that perhaps even half of them win in the end. So how do you make sure you get into the right stuff?
Well, it's really about that fundamental research. We're looking for strong balance sheets. We're looking for really rigorous management teams. We're looking for differentiators, and we see it all over the world. It's if you sort of take off the cover of some of the highlights and the earnings, and you actually look underneath the covers of company management plans and where they're thinking about allocating capital, that's when you understand not just where the company is today, but where they're headed. And that's what we're thinking about when we're investing portfolios.
I have just a question on, we have notes, right? Our producer, Lee Brody, we couldn't do the show without him. He puts together an amazing pre-interview with all of our guests.
So he just loves it when we tear it right up.
No, I'm not. I'm just noticing here, you say, at least according to these notes, I'm thinking, is this a typo? Or granolas can offer diversification. What are granolas?
Granolas, that's an acronym. I'm surprised you guys haven't been talking about granolas, but these are the international companies that acronym stands for multiple in consumer and luxury goods companies in Europe, in the international market. So.
I was thinking because it's Climate Week, this had something to do with, like, tree hugging.
Yeah, no. It's
environmental,
but very much
it's nothing like that.
It's diversifying away from technology by buying some of these large multinationals that are based in Europe, and those are the granola stocks.
Okay, so the idea that we were talking about with, because I always think about that, by the way, when I look at the FTSE. People often think the FTSE may be a bad investment if the UK economy is having a problem,
right.
But almost all the companies in the FTSE are really global in terms of reach. So it's not really an investment in the UK at all.
Absolutely.
Yeah,
you need to think about where that company is getting their revenue from. Another area that we're thinking about a lot is dividend-paying stocks, which I think is really interesting in this environment. So something else to think about.
I actually want to go back to those European luxury names because it ties in really nicely. As we mentioned, of course, there's China exposure there as well. And you're seeing a lot of those names, those European luxury names, have a great day after China, of course, released not quite a bazooka, but definitely a blitz of stimulus measures. When you're buying those European luxury names, when you're evaluating them, doing that fundamental research, how big of a factor is China?
Well, it's a significant factor, but so is India. So is the U.S. So is Europe. So is Japan. So we're thinking broader than just China. We are seeing a slowdown in China. We think that continues. So we're not as constructive about China as we are for places like India, or even some of the European or Japan is another area that we're interested in looking at. So China is certainly a big bellwether and certainly a big source of consumer spending, but we're not as constructive on the Chinese economy as we were, 5 or 6 years ago.
Maddi, great to have you in the studio. Katie just sent me a story from MoneyWeek.com. The term granola, coined by Goldman Sachs in 2020 based on an acronym of 11 stocks: GlaxoSmithKline, Roche, ASML, Nestle, Novartis, Novo Nordisk. It's already a lot of N's. It's already too many N's. L'Oreal, LMVH, AstraZeneca, SAP, and Sanofi.
Is there a granola index that you can make into an ETF for Katie?
I'm sure somebody at Bloomberg, someone at Bloomberg has put it together for sure. Yeah. Great having you in.
Nice to be
hope
here.
you come back and visit us. Maddi Dessner there.
Thank you so
Capital
much.
Group Head of Global Asset Classes. Thanks so much. Coming up, the IPO pipeline remains strong at the Nasdaq. We're going to talk to Jeff Thomas, Nasdaq Chief Revenue Officer and Global Head of Listings next. This is Bloomberg.
All right, it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Jefferies downgrading Starbucks to a sell rating and a street low of $76. The analyst says that it's too early to get excited about the new CEO and cites other challenges that the coffee giant faces, such as culture, value perception, and technology innovations. Next up, we have Truist Securities upgrading Walmart to a buy, citing the discount retailer's market share gains across all income levels. Meanwhile, the firm is cutting its rating on Costco, noting its stretched valuation. And finally, Oppenheimer raising lows to a buy. The analyst says that the upgrade reflects a still discounted stock valuation, Matt.
All right, very interesting stuff there, Katie. Thanks very much for that. Let's get to IPOs because all signs point to a strong year for offerings on the Nasdaq. The exchange has raised $17 billion in proceeds across 110 listings so far this year. That does not, however, include the over 100 filings that are in the pipeline. Here to look at the next stages of growth is Jeff Thomas, Nasdaq Chief Revenue Officer and Global Head of Listings for Nasdaq's Capital Access Platforms Division. Jeff, thanks for joining us on Open Interest. I wonder first about the rate environment. How much does this affect IPOs? You know, we were looking at tightening, and then higher for longer. We finally have a cut. It's a big one, 50 basis points, and that must make access to capital for a lot of these companies a little bit cheaper. Does it change the picture in your pipeline?
Absolutely. Our IPO index, which predicts the future performance and number of IPOs, has the rate, federal rate, as one of the key indicators. We look across 6 macroeconomic indicators, including some of our internal data, and we've backtested that against 30 years of data. And we've been able to see that there's a strong correlation between a number of those macro factors, including rates, overall stock performance valuation, that predicts how many IPOs are going to be coming out in the future. And it's at multi-year highs right now.
It's interesting, Jeff. You think about the calendar ahead, and there could be a lot of choppiness with the U.S. election. When you talk to clients across the globe, really, that are looking to list here in the United States, are they waiting into 2025 to bypass some of that, or trying to front run a little bit as well? We are seeing some hit the tape in the coming weeks.
Yeah, I mean, obviously, I think a lot of people are going to avoid November. We do have a number of exciting deals lined up for October. We also have some companies talking about trying to get out in December. We had a few really well-performing healthcare deals that came out post-Labor Day. We were really excited to see those continue to trade above issue price. We see a lot of private equity-backed companies considering the public markets as a way to create liquidity for their sponsors. That's been over half of the proceeds raised so far this year. And when we start to think about tech IPOs, I think a lot of those venture-backed tech companies are probably going to hold off until 2025.
And let's talk about what you've been doing in the meantime, of course, as you ride out this drought and maybe wait for those companies to come out of the pipeline into the public markets. Nasdaq, of course, has been seeing a lot of listing switches, actually. Of course, companies switching their listing from one exchange maybe to the Nasdaq. Talk us through what the courting process looks like there. I mean, what motivates a company to go from one exchange to another?
Yeah, we just achieved a big milestone, our 500th exchange transfer. It wasn't so long ago that the rules around the U.S. capital markets meant that if you changed exchanges, you had to leave your stock ticker with you. The SEC relooked at that rule a number of years ago. They gave companies the choice to take their stock ticker with them. So if you transfer from the NYSE to NASDAQ, you actually keep the same stock ticker. And that was really what unlocked our ability to go and compete for not just new listings, but existing listings. And so since that rule changed, we've had over 500 companies transfer to NASDAQ, representing nearly $2.7 trillion in market cap, measured at the time of when they make that switch. So why do they do it? A lot of it is the brand affiliation with NASDAQ. They want to be associated with the most innovative companies in the world. It's our investor relations business. So we work with companies on both exchanges in the US to help power their investor relations programs to help these companies find their next great shareholder. And then I think the index opportunities, including the NASDAQ 100, is another significant driver for large cap transfers. We now have over 400 billion in assets under management tracking the NASDAQ 100 index.
Well, Jeff, you brought up one of my favorite topics, and that's tickers. I cover ETFs very closely, and the ticker game is very, very important. And it's interesting. You think about U.S. exchanges, there's a 4-character limit on tickers. Meanwhile, you look at Europe and in Asia, you can go to 5 characters, you can have numbers in there. It's very different than the US markets. Are you worried that there could be a ticker shortage perhaps approaching as we see more and more ETFs launch? And are there any talks or discussions about maybe expanding that character limit?
You know, back in kind of 2020 and 2021, especially with the proliferation of new listings and a lot of SPACs coming to market, we did see started to have some of those concerns. Over the past few years, though, unfortunately, we started to see a decline in the number of U.S. listed companies as a number of companies have been delisting. And so I don't think there's any concerns today around a ticker shortage. We do occasionally get questions from companies saying, hey, how can I get more creative on these tickers? Can I include numbers in addition to letters? But no plans right now to go from 4 to 5 characters.
Porsche, by the way, has P911, which is pretty cool. I didn't even know that was possible in Germany because all the tickers I've looked at have been letters.
Yeah. Memorize sometimes.
I wonder about, you mentioned SPACs, Jeff, and the whole meme stock thing. We sort of saw that come back a little bit this summer. Is that something that you still have your eye on, especially the SPAC, right? Because it was such an interesting idea and so many people took advantage of it. It seemed to kind of fizzle out. How's that business?
Yeah, it's actually more robust than you would think. We're still going to see probably around 3 dozen SPAC IPOs this year. It actually continues to work incredibly well as an alternative way for certain companies to come to market. We obviously saw maybe a little over exuberance in 2021. You know, at Nasdaq, we're all about providing all the different pathways to the public markets, whether it's a traditional IPO, a combination with a SPAC or a special purpose acquisition company, or a direct listing. So we're increasingly having a few more conversations with companies around that topic, which again was all the rage a few years ago, and I think we'll see some companies interested in that next year as well.
Private equity, SPACs, and maybe even some technology. Nasdaq's Jeff Thomas, we thank you so very much for your time today. Of course, those listings are coming back. Now, coming up, we're going to look at the Justice Department's antitrust division on the verge of targeting Visa's debit card business. That's next in our Wall Street beat. This is Bloomberg. I want to bring you some commentary from Fed Governor Michelle Bowman this hour. She said, quote, by moving at a measured pace toward a more neutral policy stance, we will be better positioned to achieve further progress in bringing inflation down to our 2% target while closely watching the evolution of labor market conditions. Remember, she also said that she will remain cautious in her approach to further cuts. The reason this is important, of course, is because Mickey Bowman was a dissent in that 50 basis point rate cut. And of course, that was the first governor to dissent since 2005. We will watch these moves very closely and bring you more Fed speak this week as it comes. But time now for the Wall Street beat, because we are watching Visa. The Justice Department is set to file a lawsuit against Visa, alleging that it illegally monopolized the U.S. debit card market, according to people familiar with the market. And a report commissioned by SoFi in 2023 found that 73% of Americans have a debit card from Visa. Matt, take that stat. Let's discuss this with Bloomberg's Sridhar Natarajan. Of course, you are seeing Visa shares move on the heels of this exclusive news from Bloomberg. And you do see really the FTC crack down on the credit card industry in a quite difficult manner here. What exactly?
These are debit cards.
These are debit
not
cards.
Credit cards. And mine is by Mastercard.
And this is the DOJ antitrust division. But at the same, what is important here is every year merchants pay over $170 billion in all sorts of fees tied to credit cards, debit cards, electronic payments. So the FTC, the DOJ, the Biden administration in general has had a very muscular antitrust posture. We've talked about that recently. And this is another case where they believe the middlemen here, the middlemen in this case, Visa and the Mastercards of the world, the payment networks, are carrying out behavior that abuses their dominance in the market, or at least that's what they plan to accuse Visa of in this case. And the end goal will be that the cost should ultimately come down for the merchants and therefore the consumer and the customer.
The consumer isn't directly hurt by this alleged monopoly, right? Because you don't pay fees when you use your debit card. It's the retailer that ends up paying the swipe fee.
Depends on who you ask. We had a grocery retailer here furious about those swipe fees.
Yeah, but that's because the retailer is directly hurt.
And then passes them on.
Yeah.
Right, but first let me address your alleged monopoly question, because that's something that you've been asking all morning. So
yeah, because I've been I've walked around the newsroom, I asked everybody,
it's a fair
is
question.
your debit card Mastercard or Visa?
Question.
I find, at least in our newsroom, half of people's debit cards are Mastercard and half are Visa.
Well, that is not broader America, it seems, because undoubtedly Visa and Mastercard are the two dominant payment networks when it comes across credit cards and debit cards all over the world. But when you talk about the US debit card market, Visa has a more than 70 or roughly 70% share. The rest is mostly Mastercard, but Visa is the dominant player there. And this case that the DOJ is bringing is about the US debit card market. So you can argue that they have a dominant position. I won't use the word monopoly. That is a charged word. We'll leave that to the Justice Department. But they clearly have a dominant position. And perhaps in the accusations, they lay out how they've been abusing this dominance, whether it is thwarting competitors or striking exclusive agreements that make it harder for merchants to route their transactions elsewhere.
Sri, I always learn something when you come on. So thank you very much. Sri Natarajan there talking to us about this suit. Coming up in the next hour, Goldman Sachs' David Kostin joins us to talk his market outlook and tell us how he sees stocks benefiting from slower wage growth. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We're waiting for more eco data to cross the terminal, of course. The Fed has trained us well. We watch every single report right now. We're kind of in a vacuum, of course. We're waiting for consumer confidence right now. And that's what we really care about. And that's what the Fed cares about, the consumer, the health of the consumer as we get more jittery.
Oh, we got it, and it's a big miss.
It's a big miss,
no.
actually.
Yeah, we were looking for, this is the Conference Board Consumer Confidence Index. We were looking for a reading of 104. We actually got a reading of 98.7, which not only misses the surveyed number, but is also below the previous reading of 103.3. So that is the kind of thing that could dent stocks.
You have a marginal move in the 2-year, about 1 basis point. The reason I like to watch this still, even if it's not moving by much, is to see how much really these wagers have already been priced in after the drastic moves we've had the last couple of weeks.
Let's get to the stock market because we are seeing a move there. You take a look at the S&P 500 right now, currently down about 0.2%. We had been a little bit higher, of course, after the opening bell in the pre-market. We got that 40th record close yesterday. Right now, it doesn't look too pretty. Of course, that consumer confidence whiff taking a dent in stocks right now. Not huge moves. Let me move my drink to over here. But, of course, it's the direction of travel right now. It matters. It's the color on the screen.
What is that? Is that like an iced tea? Are you drinking an Arnold Palmer?
I'm not. So this is a little bit of tropical juice with seltzer.
Nice.
It would taste great with, a splash of something else.
It would make you feel a little bit better after this consumer confidence number, because that is basically a dour taste here.
You have to imagine that would be the case. Remember, over the last 5 days, it was really consumer discretionary that was holding up the S&P 500 in a lot of ways. So, of course, the reversal of that sentiment would lead to that kind of a move.
Let's take a look at the markets with David Kostin, why don't we? He's Goldman Sachs' chief U.S. equity strategist, so he's one of the best people I could think of to talk to about this. And David, you've also said that labor costs, that falling wage costs should help to boost stocks. That's what I was looking at in your most recent research and thinking about. Mickey Bowman has been talking about the effect of immigration on the labor market and costs there. And I was just thinking, if the Biden administration has finally stopped, the flood of immigrants over the border, and if maybe the next administration continues to hold that tight and even, send some workers home to their original countries, don't we see upward pressure on wages coming to us?
Well, I think you want to think about it as a portfolio manager. And the question there is to focus on the distribution of labor costs, the cost sensitivity of a company to its input of labor and workers. And so if you look at this, Matt, as a overall market, something like 12% of the sales of a typical company are consumed by the labor budget. Use that term, labor budget. That's your wages, your salaries, your bonuses, your healthcare costs. All that is going to consume around 12% for the overall market, maybe 14% for the typical stock. And you want to look at it, and the way we think about it is the distribution. There are some companies where that ratio is at the low end, maybe 5%, 6%. And there are others, other industries, other companies where it's closer to 30%. So now you can start to identify as an investor which companies have more leverage, which have more torque to the idea of a slowing wage inflation environment. And those are companies where the labor cost ratio can be high, where the potential benefits from slower growth in wages could be a benefit to the share prices. And in fact, in the last couple of weeks, we've seen around 9 percentage points excess return for high labor cost companies relative to lower labor cost companies. You think of that long short from a hedge fund perspective. That's how we think about it as an investor.
So you're using it in active management, because if I just look at the market as a whole, I can understand how lower labor costs would benefit the bottom line of these companies when they come out for earnings. On the other hand, it really hurts consumer confidence, or it looks like maybe it has an effect on consumer confidence. We get a big miss on that today. And then, in turn, consumer spending.
So yes, the consumer area is an interesting one. If you look at consumer staples, for example, a typical company is about 9% of its cost structure is consumed by labor. So first of all, we want to think of that. The rest of the cost structure of a company is its materials or it's the actual foodstuffs, what have you, depending on the company, consumer products or the food company, for example. So labor, you got to put that in context. But to the extent that their margins as a general industry are pretty low, that makes a big difference. On the other hand, look at technology, the other end of the distribution. You got, generally speaking, higher compensated employees, and their ratio of the labor budget to the revenues is much higher. On the other hand, their margins are also higher. And so there's different ways of thinking about companies. There's companies in each industry where there are higher or lower cost structures and labor. And so we want to keep that labor cost in context as a way of identifying individual companies. I think the way we focus most attention right now is on mid-cap stocks, because mid-cap stocks is the area of the market that's gets the least attention by the part of many portfolio managers. I just spent a couple of days visiting with almost 45 portfolio managers, and lots of discussions on large cap and small cap, but what is not generally on their radar screen is mid-caps. Mid-cap stocks have a long track record of better performance than large cap and small caps. Number one, they trade at much lower multiples, 15 times. The overall market's closer to 21, almost 22 times in some cases. So you got better value. They are the best performance after a Fed cut. The Fed obviously cut last week, so over the 3-month, over a 12-month period of time, mid-cap stocks tend to do better. And so that's the area of focus for most, that's what we're certainly talking about with fund managers, an area that's not overlooked, if you will, but really is likely to outperform in the coming year. Looking at something like 13% upside over the next 12 months, broadly speaking, the market maybe is closer to mid-single digits.
Well, David, let's talk about that a little bit more. I'm glad you brought up the mid caps, because you're right. We talk about the large caps, we talk about the small caps, we ignore the middle. And I feel like that's because maybe we have, personalities or characteristics easily identifiable that we assign to those two cohorts. But when you think about the quintessential mid cap stock, what does it look like?
You're looking at a company somewhere between $5 and $20 billion in equity cap. So the definition of mid-cap has sort of moved up. Think about that, number one. Number two, think about small-cap stocks, maybe a new IPO after a couple of years. It's a survivor bias. If it's a small company rapidly growing and continues to grow, it sort of gets promoted into the next category as a mid-cap stock. You can look at the S&P 400, for example. It's a good way of thinking about that. There's an ETF around it, but that's a good starting point to think about what does that constitute. Companies in that market cap size, they tend to have stronger balance sheets than weaker or smaller cap stocks. So if you're thinking about the Russell 2000 as an example, right? There's 2,000 stocks. A third of those companies actually lose money, have negative net income. That is a much lower. That's obviously very high, and so we think about the dynamics around their balance sheet strength. There's a lot of concerns about some of the smaller cap companies. Mid-cap companies generally have better balance sheets, number one. Number two is you think about the exposure to floating rate debt. This is why these companies tend to do well when the Fed is cutting rates. About 25% of their borrowings are floating rate. So there's a one-to-one benefit. Fed cuts rates, lower interest expense, you got higher earnings as a result, positive earnings revisions, that tends to lead to outperformance. In contrast, you look at the large cap stocks, maybe 7% of their borrowings are in a floating rate form. And so there's some benefit, of course, lower rates, but doesn't have as much of a torque, a drive to the bottom line. So that's an area you've got value. They trade lower multiples in mid-caps.
Right.
They are, by definition, sort of the mid-cap area, $5 to $20 billion. And they have leverage for the reasons I just explained. That's why they outperform when the Fed starts cutting.
Right. Well, just to quickly tie a bow on this point, I mean, I'm glad you brought up quality, because the argument against just buying the Russell 2000, for example, broad brushstrokes, is that you fall into a lot of value traps, that basically those companies are small caps for a good reason. David, it sounds like what you're saying is you sort of filter out for maybe some of those junkier companies when you move up just a little bit when it comes to the market cap.
That's essentially what happens. They're basically they get promoted, if you will. I call it the survivor bias, and that's the positive. You also have some companies on the other end, maybe that were in the large cap index that maybe some companies outperform, and these are the ones that maybe fall. So that mid cap spot, it doesn't get as much focus as the large or the small cap, and that's, I think, an area that's why we're focused on opportunity set, because the broad equity market trades at a high valuation, and that's a concern. There's a lot of concerns, but that's one of them in particular, that your starting point in value matters in terms of your forward returns. And so you get about this mid-cap stocks trade around 15 times forward earnings. The broader market trades something like 20, 21, 22 times, which is expensive relative to history.
You know, David, it's interesting to see your price target right now for the S&P still stands at about 5,600. We are above that level right now. We're above 5,700. Your price target does imply declines. What would get us there? Or do you anticipate you would raise your price target again? You've already done so, I believe, 3 times this year.
So, way to think about that. We're a little more than a month and a half away from the election. Historically speaking, volatility goes up. Prices come down. There's uncertainty by definition around the election. So that would be, from a near-term perspective, some concern. That is usually resolved, meaning the uncertainty gets resolved with the election. As a result, equities over time have tended to rally post the election. So if you think about tactically, I would say there's concern based on history around the ahead of the election, and then usually get a rally towards the end of the year. We look out a year from now, S&P 500 likely to be closer to 6,000. It's a target we have. So we think about sort of near-term target, 5,600 at the end of this year, and maybe 12 months ahead, looking around 6,000.
I wonder, you know, we got headlines earlier from Speaker Johnson about the possibility of an omnibus bill, saying that they won't do one at Christmas. It's very wonky, but right now they've sort of kicked the can to December 20th, and they're going to, in terms of a government shutdown, and kick it further. How much does this kind of government stuff affect your outlook? I mean, from, you know, the potential of a shutdown to the election, how in the weeds do you get, David, in terms of politics when you're looking at stocks?
Well, I have the benefit of an excellent U.S. economics team here at Goldman, so they can help inform the drivers of our earnings model and thinking about valuation rates and things like that. But ultimately, what does drive equity prices is the economic backdrop. And you mentioned some of the issues in Washington, D.C., of course, but the idea of the consumer still growing, balance sheets are strong, most companies are in a position where they're raising their dividends. That's a backdrop that's usually pretty optimistic from a trajectory of the equity market. There's not a lot of imbalances that we see across the economy. So our objective has been try to find individual companies that are benefiting from whatever sort of macro developments that are taking place. I highlighted before companies with higher labor component to their cost structure. They would benefit from an easing, sort of cooling of the labor market. Less wage inflation, so that's one area we focus on. We think about the duration, when the companies are generating their cash flows, looking into the future. The idea of the interest rate environment is obviously
David,
shifting. So
I'm sorry to interrupt, David. Speaking of the government, President Biden is just walking out at the UN General Assembly. He's going to be addressing the United Nations. So,
fellow leaders,
with all due respect, we're going to listen in.
This is the 4th time I've had the great honor of speaking to this assembly as President of the United States. It'll be my last. I've seen a remarkable sweep of history. I was first elected to office in the United States of America as a U.S. Senator in 1972. Now, I know I look like I'm only 40. I know that. I was 29 years old. Back then, we were living through an inflection point. a moment of tension and uncertainty. The world was divided by the Cold War. The Middle East was headed toward war. America was at war in Vietnam. At that point, the longest war in America's history. Our country was divided and angry, and there were questions about our staying power and our future. But even then, I entered public life not out of despair, but out of optimism. The United States and the world got through that moment. It wasn't easy or simple without significant setbacks. But we go on to reduce the threat of nuclear weapons through arms control, and then go on to bring the Cold War itself to an end. Israel and Egypt went to war, but then forged a historic peace. We ended the war in Vietnam. The last year in Hanoi, I met with the Vietnamese leadership. We elevated our partnership to the highest level. It's a testament to the resilience of the human spirit and the capacity for reconciliation. That today, the United States and Vietnam are partners and friends. And it's proof that even from the horrors of war, there's a way forward. Things can get better. We should never forget that. I've seen that throughout my career. In the 1980s, I spoke out against apartheid in South Africa. And then I watched the racist regime fall. In the 1990s, I worked to hold Milosevic accountable for war crimes. He was held accountable. At home, I wrote and passed the Violence Against Women Act to end the scourge of violence against women and girls, not only in America, but across the world, as many of you have as well. But we have so much more to do, especially against rape and sexual violence as weapons of war and terror. We were attacked on 9/11 by al-Qaeda and Osama bin Laden. We brought him justice. Then I came to the presidency at another moment of crisis and uncertainty. I believed America had to look forward. New challenges, new threats, new opportunities were in front of us. We needed to put ourselves in a position to see the threats, to deal with the challenges, and to seize the opportunities as well. We need to end the era of war that began on 9/11. As Vice President to President Obama, he asked me to work to wind down the military operations in Iraq, and we did, painful as it was. When I came to office as president, Afghanistan had replaced Vietnam as America's longest war. I was determined to end it, and I did. It was a hard decision, but the right decision. 4 American presidents had faced that decision, but I was determined not to leave it to the 5th. It was a decision accompanied by tragedy. 13 brave Americans lost their lives, along with hundreds of Afghans in a suicide bomb. I think those lost lives, I think of them every day. I think of all the 2,461 U.S. military deaths over a long 20 years of that war. 20,744 American servicemen wounded in action. I think of their service, their sacrifice, and their heroism. I know other countries lost their own men and women fighting alongside us. We honor their sacrifices as well. To face the future, I was also determined to rebuild my country's alliances and partnerships to a level not previously seen. We did just that, from traditional treaty alliances to new partnerships like the Quad with the United States, Japan, Australia, and India. I know many look at the world today and see difficulties and react with despair, but I do not. I won't. As leaders, we don't have the luxury. I recognize the challenges from Ukraine to Gaza to Sudan and beyond. War, hunger, terrorism, brutality, record displacement of people, a climate crisis, democracy at risk, strains within our societies, the promise of artificial intelligence and its significant risk. The list goes on. But maybe because all I've seen and all we have done together over the decades, I have hope. I know there is a way forward. In 1919, the Irish poet William Butler Yeats described a world, and I quote, "where things fall apart, the center cannot hold, mere anarchy is loosed upon the world," end of quote. Some may say those words describe the world not just in 1919, but in 2024. But I see a critical distinction. In our time, the center has held. Leaders and people from every region and across the political spectrum have stood together, turned the page. We turned the page in the worst pandemic in a century. We made sure COVID no longer controls our lives. We defended the UN Charter and ensured the survival of Ukraine as a free nation. My country made the largest investment in climate, clean energy, ever anywhere in history. There will always be forces that pull our countries apart and the world apart. Aggression, extremism, chaos, and cynicism. A desire to retreat from the world and go it alone. Our task, our test, is to make sure that the forces holding us together are stronger than those that are pulling us apart. That the principles of partnership that we came here each year to uphold can withstand the challenges. That the center holds once again. My fellow leaders, I truly believe we're at another inflection point in world history. But the choices we make today will determine our future for decades to come. Will we stand behind the principles that unite us? Will we stand firm against aggression? Will we end the conflicts that are raging today? Will we take on global challenges like climate change, hunger, and disease? Will we plan now for the opportunities and risk of a revolutionary new technologies? I want to talk today about each of these decisions and the actions, in my view, we must take. To start, each of us in this body has made a commitment to the principles of the UN Charter to stand up against aggression. When Russia invaded Ukraine, we could have stood by and merely protested. But Vice President Harris and I understood that that was an assault on everything this institution was supposed to stand for. And so, my direction, America stepped into the breach, providing massive security and economic and humanitarian assistance. Our NATO allies and partners in 50-plus nations stood up as well. But most importantly, the Ukrainian people stood up. I asked the people of this chamber to stand up for them. The good news is Putin's war has failed and at his core aim. He set out to destroy Ukraine, but Ukraine is still free. He set out to weaken NATO, but NATO is bigger, stronger, and more united than ever before, with 2 new members, Finland and Sweden. But we cannot let up. The world now has another choice to make. Will we sustain our support to help Ukraine win this war and preserve its freedom, or walk away and let aggression be renewed and a nation be destroyed? I know my answer. We cannot grow weary. We cannot look away. And we will not let up on our support for Ukraine, not until Ukraine wins a just and durable peace in the UN Charter. We also need to uphold our principles as we seek to responsibly manage the competition with China so it does not veer into conflict. We stand ready to cooperate on urgent challenges for the good of our people and the people everywhere. We recently resumed cooperation with China to stop the flow of deadly synthetic narcotics. I appreciate the collaboration. It matters for the people of my country and many others around the world. On matters of conviction, the United States is unabashed, pushing back against unfair economic competition, against military coercion of other nations and in the South China Sea, in maintaining peace and stability across the Taiwan Straits, in protecting our most advanced technologies so they cannot be used against us or any of our partners. At the same time, We're going to continue to strengthen our network of alliances and partnerships across the Indo-Pacific. These partnerships are not against any nation. They're building blocks for a free, open, secure, and peaceful Indo-Pacific. We're also working to bring greater measure of peace and stability to the Middle East. The world must not flinch from the horrors of October 7th. Any country would have the right and responsibility to ensure that such an attack can never happen again. Thousands of armed Hamas terrorists invaded a sovereign state, slaughtering and massacring more than 1,200 people, including 46 Americans, in their homes and at a music festival. Despicable acts of sexual violence, 250 innocents taken hostage. I've met with the families of those hostages. I've grieved with them. They're going through hell. Innocent civilians in Gaza are also going through hell. Thousands and thousands killed, including aid workers. Too many families dislocated, crowding into tents, facing a dire humanitarian situation. They did not ask for this war that Hamas started. I put forward with Qatar and Egypt a ceasefire and hostage deal. It's been endorsed by the UN Security Council. Now is the time for the parties to finalize its terms, bring the hostages home, and secure security for Israel and Gaza free of Hamas' grip, ease the suffering in Gaza, and end this war. On October 7th, since October 7th, we've also been determined to prevent a wider war that engulfs the entire region. Hezbollah, unprovoked, joined the October 7th attack, launching rockets into Israel. Almost a year later, too many on each side of the Israeli-Lebanon border remain displaced. A full-scale war is not in anyone's interest. Even if the situation has escalated, a diplomatic solution is still possible. In fact, it remains the only path to lasting security to allow the residents from both countries to return to their homes and the border safely. And that's what we're working tirelessly to achieve. As we look ahead, we must also address the rise of violence against innocent Palestinians on the West Bank and set the conditions for a better future, including a two-state solution where Israel enjoys security and peace and full recognition and normalized relations with all its neighbors, where Palestinians live in security, dignity, and self-determination in a state of their own. Progress toward peace will put us in a stronger position to deal with the ongoing threat posed by Iran. Together, we must deny oxygen to its terrorist proxies, which have called for more October 7th and ensure that Iran will never, ever obtain a nuclear weapon. Gaza is not the only conflict that deserves our outrage. In Sudan, a bloody civil war unleashed one of the world's worst humanitarian crises. 8 million on the brink of famine. Hundreds of thousands already there. Atrocities in Darfur and elsewhere. The United States has led the world in providing humanitarian aid to Sudan. And with our partners, we've led diplomatic talks to try to silence the guns and avert a wider famine. The world needs to stop arming the generals, to speak with one voice and tell them, stop tearing your country apart, stop blocking aid to the Sudanese people, end this war now. But people need more than the absence of war. They need a chance to live in dignity. They need to be protected from the ravages of climate change, hunger, and disease. Our administration has invested over $150 billion to make progress and other sustainable development goals. It includes $20 billion for food security, over $50 billion for global health. We've mobilized billions more in private sector investment. We've taken the most ambitious climate action in history. We've moved to rejoin the Paris Agreement on day one. And today, my country is finally on track to cut emissions in half by 2030. On track to honor my pledge to quadruple climate financing to developing nations with $11 billion thus far this year. We've rejoined the World Health Organization, donating nearly 700 million doses of COVID vaccine to 117 countries. We must now move quickly to face Mpox outbreak in Africa. We're prepared to commit $500 million to help African countries prevent and respond to Mpox and to donate 1 million doses of Mpox vaccine now. We call on our partners to match our pledge and make this a billion-dollar commitment to the people of Africa. Beyond the core necessities of food and health, the United States, the G7, and our partners have embarked on an ambitious initiative to mobilize and deliver significant finance to the developing world. We're working to help countries build out their infrastructure, to clean energy transition, to the digital transformation, to lay new economic foundations for a prosperous future. It's called the Partnership for Global Infrastructure and Investment. We've already started to see the fruits of this emerge in Southern Africa and Southeast Asia and in the Americas. We have to keep it going. I want to get things done together. In order to do that, we must build a stronger, more effective, and more inclusive United Nations. The UN needs to adapt and bring new voices and new perspectives. That's why we support reforming and expanding the membership of the UN Security Council. My UN ambassador just laid out our detailed vision to reflect today's world, not yesterday's. It's time to move forward. The Security Council, like the UN itself, needs to go back to the job of making peace, of brokering deals to end wars and suffering. And to stop the spread of the most dangerous weapons, of stabilizing troubled regions in East Africa, from East Africa to Haiti, to Kenya-led mission that's working alongside the Haitian people to turn the tide. We also have a responsibility to prepare our citizens for the future. We'll see more technological change, I argue, in the next 2 to 10 years than we have in the last 50 years. Artificial intelligence is going to change our ways of life, our ways of work, and our ways of war. It could usher in scientific progress at a pace never seen before, and much of it could make our lives better. But AI also brings profound risks, from deep fakes to disinformation, to novel pathogens, to bioweapons. We've worked at home and abroad to define the new norms and standards. This year, we achieved the first ever General Assembly resolution on AI to start developing global rules of the road. We also announced a declaration on the responsible use of AI, joined by 60 countries in this chamber. But let's be honest, this is just the tip of the iceberg, what we need to do to manage this new technology. Nothing is certain about how AI will evolve or how it will be deployed. No one knows all the answers. My fellow leaders, it's with humility I offer 2 questions. First, how do we as an international community govern AI? As countries and companies race to uncertain frontiers, we need an equally urgent effort to ensure AI's safety, security, and trustworthiness. As AI grows more powerful, it also must grow more responsive to our collective needs and values. Benefits of all must be shared equitably. It should be harnessed to narrow, not deepen, digital divides. Second, will we ensure that AI supports rather than undermines the core principles that human life has value and all humans deserve dignity? We must make certain that the awesome capabilities of AI will be used to uplift and empower everyday people, not to give dictators more powerful shackles on the human spirit. In the years ahead, there may well be no greater test of our leadership than how we deal with AI. Let me close with this. Even as we navigate so much change, one thing must not change. We must never forget who we're here to represent. We, the people. These are the first words of our Constitution, the very idea of America. They inspired the opening words of the UN Charter. I made the preservation of democracy the central cause of my presidency. This summer, I faced a decision whether to seek a second term as president. It was a difficult decision. Being president has been the honor of my life. There's so much more I want to get done. As much as I love the job, I love my country more. I decided after 50 years of public service, it's time for a new generation of leadership to take my nation forward. My fellow leaders, let us never forget, some things are more important than staying in power. It's your people. It's your people that matter the most. Never forget, we are here to serve the people, not the other way around. Because the future will be won by those who unleash the full potential of their people, to breathe free, to think freely, to innovate, to educate, to live and love openly without fear. That's the soul of democracy. It does not belong to any one country. I've seen it all around the world, and the brave men and women who ended apartheid, brought down the Berlin Wall, fight today for freedom and justice and dignity. We saw it, that universal yearning for rights and freedom in Venezuela, where millions cast their vote for change that hadn't been recognized. But it can't be denied. The world knows the truth. We saw it in Uganda, LGBT activists demanding safety and recognition of their common humanity. We see it in citizens across the world peacefully choosing their future. From Ghana to India to South Korea, nations representing 1/4 of humanity who will hold elections this year alone. It's remarkable, the power of we the people, that makes me more optimistic about the future than I've ever been. Since I was first elected to the United States Senate in 1972, every age faces its challenges. I saw it as a young man. I see it today. But we are stronger than we think. We're stronger together than alone. And what the people call impossible is just an illusion. Nelson Mandela taught us, and I quote, "It always seems impossible until it's done. It always seems impossible until it's done." My fellow leaders, there's nothing that's beyond our capacity if we work together. Let's work together. God bless you all, and may God protect all those who seek peace. Thank you.
And that, of course, was President Joe Biden giving his final speech to the United Nations General Assembly. An interesting speech, of course, speaking about his decision not to seek a second term, quoting a bit of poetry, also talking about the U.S. relationship with China and reiterating U.S. support for Israel. Let's break it all down now with Bloomberg senior editor Mike Shepard joining us from Washington. So, Mike, as you would expect, of course, a big focus on the tense geopolitical backdrop that we're living in right now, but also on his legacy as president.
Yes, this was very much, Katie, a look back at what Joe Biden has fought for through his political career, and he has really stressed in this speech today, and that is collective action. He ended his speech with "let's work together," and that really signals what he was talking about and sums it up very nicely. He pointed to collective efforts in fighting the pandemic, in trying to address climate change, and also in trying to meet the challenge of Russia's invasion of Ukraine. All of these have had mixed success and mixed results, and yet he still emphasized the importance of doing that. And toward the end of the speech, also, he highlighted a future challenge for the next generation of leaders, and that is artificial intelligence, another area where he sees the need for collective action.
You know, this government has been supporting Benjamin Netanyahu's war on Gaza with billions of dollars in aid and weapons, but he did seem very unhappy with the plight of the Palestinian people under attack. Did we learn anything about the changing view of the Biden-Harris White House on this? Maybe something that we could glean from how Harris will deal with it if she wins the election?
You know, this wasn't really so much a new revelation from the president on the world stage there, but it is certainly the highest profile space where he has expressed concern and displeasure with the intensity of the violence against Palestinians in Gaza, and now what we're seeing in the north of Israel in the intensifying attacks in southern Lebanon. While the president was emphasizing Israel's right to defend itself, he made clear that he is pushing for, and his administration has been pushing for, a ceasefire, one that would end the hostilities and violence and maybe lead to a more lasting peace there.
All right, Mike Shepard, really appreciate your reporting, of course. That is Mike Shepard in Washington, joining us to break down, of course, President Joe Biden's final speech to the United Nations General Assembly. Meanwhile, let's take a check on these markets. Of course, over an hour into the U.S. trading day, you can see that rally has turned into a decline after we got those consumer confidence figures at the top of the hour, missing estimates, and you can see that reflected in the market right now. The S&P 500 currently down about 0.3%, pretty much an even split if you take a look at the sector level. Of course, on the downside, leading declines, you have financials and you also have big tech. And you can see that, of course, reflected in the Nasdaq 100, currently down about 0.5%. Of course, we hit a record yesterday, at least at this moment, Matt. It is out of our reach.
Yeah, we don't know what happens throughout the rest of the day, but I think it's fair to say that consumer confidence number was a real dampener on market bullishness today. Let's talk about shares of logistics giant Maersk. They are still rising as the threat of a U.S. port strike looms large. Of course, they're traded in Scandinavia, not here in the U.S. The strike could potentially spark a new round of supply chain disruptions that would boost freight rates. Joining us to talk more about this is Lee Klaskow, Bloomberg Intelligence Senior Transportation and Logistics Analyst. And Lee, just set up for us, for those of us who aren't as steeped in it as you are, what's going on with this strike and how broadly it could affect commerce?
Yeah, so there's a contract negotiation going on between the ILA, which is the longshoremen, and the ports up and down the eastern seaboard of the United States and the Gulf Coast. It covers around 25,000 workers. Like I said, it's a 6-year contract. The contract expires on the end of this month, so there's a real risk of a strike on October 1st, which will obviously have a pretty big impact on supply chains. It seems like a strike is probably inevitable. The both sides aren't really appear to be at the table. And so that will, muck up supply chains at a time when we're heading into the busy holiday season for freight transportation and logistics.
I think an important distinction here, Lee, is also where exactly will this start to muck up supply chains, as you say? Is it kind of evenly distributed, or can you expect certain areas to be impacted more than others?
Well, proactive shippers have probably been diverting freight away from the East Coast for real time-critical goods. So they were either moving it towards Eastern Canada or, the West Coast United States or Canada. So, that is one thing. And also shippers were probably pull forwarding demand. So they knew that this was going to be a risk. And so maybe instead of wanting to get a shipment mid-October, maybe they decided to take those shipments in early September. Who is it going to impact? It's really going to impact everything that comes in a container. And we are a global economy, so it is freight from and goods from Asia, from Europe, from Latin America. It's really going to have an impact, and it's not only the imports, it's the exports as well. So, you know, it's obviously going to be bad for supply chains. It's going to be bad for shippers, but it'll probably be good for transportation providers, and that's probably why you're seeing the action in Maersk right now. They announced a 1,500 surcharge ahead of a potential strike. So, you know, they can recoup some of the costs that they're going to have for either rerouting freight or, you know, congestion issues at the ports once things get back up and running.
Right,
so,
right. Well,
and then, you know, then you have, you know, the truck market, which has been very soft as of late. You know, that could get a boost as, you know, shippers are looking to expedite freight. It should benefit intermodal providers like the J.B. Hunts and the Hub Groups of the world and Schneider. Because, you know, you get more freight coming into the West Coast, and that land bridge will be on a railroad. You see a container on a railroad, and then final delivery by a truck. So net, it could, in my world, it could be good for earnings for the companies that I cover, bad for, you know, pretty much everybody else.
Lee, thank you so very much for all of your analysis here. Of course, it's something we're going to be keeping an eye on now for a while to come. That is Lee Klaskow of Bloomberg Intelligence. Now, coming up, a story of prudent banking. PNC CEO Bill Demchak says the Wild West days of banking are over. We're going to get to that next for Wall Street Week Daily. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And in the immediate aftermath of Silicon Valley Bank's failure, regulators and investors questioned the soundness of regional banks. Wall Street Week's David Weston asked PNC CEO Bill Demchak whether the concerns are fair.
I think we're long past a world where bankers are high flyers and are trying to bet on red. I think that ended definitively in the financial crisis. I worry more about, by putting everybody under the same microscope with the same models, we're replicating the same problems across the entirety of the system. You know, if the Fed says in a stress test that this type of loan is bad, then nobody will do it, even though we might think it's good, because regulatory capital is too high.
Well, so that's a different sort of risk, actually.
That's a bigger one.
That's a sort of risk if there's not enough diversity and innovation in the banking system, because everybody's managing to the test, basically. We're just teaching to the test, and we can pass the test just fine, but it doesn't allow people to experiment and do new and innovative things in banking.
That's right. And that, you know, the Fed itself has written a lot of papers on just how homogenous all the bank balance sheets in the country have become post the stress test. So we can do stuff at the margin, but by and large, you really penalize yourself if you step into an asset class that they just, you know, really dislike. And you've seen that, of course. So, you know, the amount of leverage lending that's left the banking system, you know, most of mortgages left the banking system. Consumer lending of certain types, buy now, pay later, all that, you know, it's kind of left the banking system. People think it's a good business, yet we're not allowed to do it because, you know, the Fed say, no, it's not a good business.
What does that mean for PNC, this shift to the so-called non-banks that's been going on? More and more traditional banking, we think of banking functions, are over into the non-banks outside the regulator. What does it mean for PNC?
At the moment, not much. In fact, it's come back. I mean, you probably have seen some headlines on a recent, what are they called, neobank failure and the loss of both insured and insured money, just in the sense that nobody knows where it is. So some of the cool stuff that I want to use an app to move my money around, people are waking up to the risk of fraud and so on and so forth. The shift of assets outside of the banking system, leverage lending and mortgage, we miss opportunities. Leverage lending isn't our core target. You know, our clients are right there in Pittsburgh or Cleveland or Texas, and they're real companies, and they're not necessarily catered to private equity or other buyout funds. But down the road, it matters. I think mortgage matters a lot.
Increasingly, we see the non-banks doing business with the banks.
Yes.
Banking with the banks. Is there a potential risk in that? Basically, that it could, what has been thought to be a non-systemic risk, could actually get into the system, particularly if we're not able to see what's going on?
Yeah, it's a really good question. You will probably remember having seen recent comments and FSOC notes, if you read that stuff, where the regulators are starting to say, wait, where's the interconnectedness here? And, you know, all of the shadow banking system, you know, if it's still called that, from the retail lenders through to the leveraged finance lenders through to hedge funds, they exist because banks provide liquidity to them. So we empower, you know, think about what's happened to the mortgage business. I think 75% of it has left banking and gone to not terribly well capitalized or funded institutions, and then banking provided them with liquidity lines for their warehousing. Things get bad, all those liquidity lines go away and they're left hanging. So it's the right conversation to have, and I'm not so sure it was. If you look specifically at that outcome, is that a good outcome? I moved it out of the banks still finance it all. I don't have line of sight into it anymore. But you know, I feel great about the banks. I just don't necessarily feel great about everything that now is non-bank that I pushed out of the system. And we'll have a day of reckoning with that at some point.
And that was the CEO of PNC speaking to our own David Weston. Of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. This is Bloomberg.
When it comes to the spread between cheap and expensive stocks, we were at a new 100th percentile in COVID. I jokingly call it the 120th percentile, which from my math friends listening to you, there is no such thing. It's just a new 100th, but it was about 20% above the prior 100th. We're back down to about the 80th percentile spread versus history. We still have a little bit of a tilt on, but far smaller than when it was 120. So I would say things are still out of whack, but it's not an arbitrage you can drive a truck through.
All right, and that was AQR Capital co-founder Cliff Asness speaking earlier on Bloomberg, talking about the opportunity in value. It's there, guys, at least according to Cliff Asness.
Wait, you're going to translate for me? Because just...
Basically, there's opportunity in value if you take a look at that percentile spread, et cetera, but you can't drive a truck through it. It's not so huge and overwhelming right now.
Listen, AQR made some of their record profits through that area right after COVID when we hit that bubble territory before that drawdown, where you saw growth stocks, which is not just tech stocks, but they do this on a price to value basis, usually price to book. And so it's cheap versus expensive for a lot of these quant folks. Let's look at it this way. The Russell 2000 growth versus value index, which is the easiest way to look at it. And you see actually just this year, for example, you had those growth stocks in the Russell 2000, if we could pull it up, really outpacing what we saw in the value index. But over the last 6 months, the same thing is not true, Matt.
All right, let's talk about what's going on right now. In terms of the S&P 500, we're getting back towards unchanged. So we did open higher. If we close higher, we're looking at a new all-time record, the 41st. As Katie told us earlier, it would be the 41st, right?
We'll see if we get there. Stay with us. This is Bloomberg.